If you purchase a house today for $400,000 with 3.5% down at 6.5% interest, how much interest do you think you're going to pay after 30 years? I don't know about you, but I used to think it was like maybe half the amount. I don't know, $200,000, maybe $250,000. Well, my friends, for that $400,000 house, there's going to be about $500,937.36 applied in just interest for 30 years. Now, odds are you're watching this video because you either are buying a house or you have already bought one, and this thought is making you lose sleep. How did you do this? How did you get yourself in this position where the bank is making so much money of interest off you? Well, what if you had an additional $500 a month to apply towards your mortgage? Now, I don't know about you, but my mom always taught me, hey, save another $100, save another $200 every month. It doesn't matter how bad or how good that month is, put something in your savings account. As I've gotten older, $500 is that number that makes me comfortable. As long as I put $500 aside in some kind of piggy bank, and in honor of my mom, I'm gonna make $500 the topic of today's video. What if we were to put an additional $500 on that mortgage payment every month? Would it actually pay it off sooner? Would it actually save money at the end of the road? Should you just keep that money in your bank account and buy more Nintendo Switch 2s and Final Fantasy Magic the Gathering packs? Or should you actually make the effort to get it done? Let's start off first by breaking down today's example. If you purchased a $400,000 house with an FHA loan, which is 3.5% down, which has two caveats. One is your loan balance will start higher because they add a premium on top of it. And secondly, your PMI is going to be stuck at this specific number, which is always 0.55. If none of that made sense to you, it's okay. Just see this video that popped up now, save that for later. Open it in a different tab and save it for later. You'll understand what mortgages and how they work. But anyways, you're probably going to have about a 6.5% rate, which is what it's currently at right now at the time of shooting this video. We're going to use standard hazard insurance. I know there's some states out there that are struggling with the high insurance, and my apologies, but we're going to use about $1,400 a year. And for property taxes, we're going to, let's say $2,000 a year. So overall, pretty low on these two, but just know in your state, this number changes depending on how much property taxes you get charged for your house and how your hazard insurance work. Like some insurances are a lot higher than $1,400 a year. So that monthly payment looks to be about $2,942. And if we break down the actual cost of this mortgage, after 30 years of not paying any additional payments, you will have paid $500,000 of interest on a loan amount of $392. So you would pay approximately $107,000 or $108,000 more of just interest than your actual house. First, I want to break down exactly why this is happening, because I think it's important that you understand how interest gets calculated on a mortgage, so that way you know how it ends up adding so much. Whenever a monthly payment is due on a house, this is what they do to calculate that. So first and foremost, there's going to be 5 different factors in your mortgage. There's going to be your principal and interest, your home insurance, your property taxes, and your mortgage insurance. As you can tell with these 3, that number is adjustable depending on where you are, and whatever your annual amount is, it gets divided by 12, and that's what they charge. This principal and interest number gets decided at the beginning of your loan amount, and how that gets decided is with 2 numbers, your loan amount and your interest rate. How we calculate your loan amount is by essentially getting your purchase price, subtracting your down payment. So that's why for some people, it's really worth getting the best price for your house, and on top of that, saving as much down payment as possible, because that number that you get for that loan amount is the one that gets applied for your payment that will never change for the rest of the mortgage until you refinance it. And for your interest rate is whatever the current market rate is, or whatever you end up buying it down to. So these 2 numbers are extremely valuable, and ends up really figuring things out for the rest of it. Now, I know a lot of us are going into this with our realtor or our lender telling us, oh, don't worry, you could just refinance down the road. That's all great and all, but we just don't know what's going to happen. We don't know if rates are going to drop. We don't know if prices are going to drop. So in my opinion, you should probably know this number and be comfortable with that number not changing for a long time, and don't just go into it with a really stretched budget, but really praying that the rates drop so you can refinance, because you're setting yourself up for failure. So in this example, our loan amount of $392, which quick caveat about FHA. How the way FHA works is they charge you a MIP, essentially like a certain percentage of the loan amount. So normally your loan amount would be 386, which is 400,000 minus the 3.5% down. But because FHA charges that, it actually goes up to 392. If you want to know more about FHA loans, there's another video for you to save for later. So that number is going to be 2482 with 48 cents. And if you can tell in our payment schedule here, that number never changes. Between June 2025 all the way to almost the last payment in 2055, that is the same principal and interest payment that you make. The only thing that changes is how much gets applied towards the interest and how much gets applied towards the principal. And how they figure out the interest is pretty simple. You get the current balance of the loan. So in this case, we're starting with the starting balance. You multiply that with the interest rate, which in this case is 6.5, and then you divide that number by 12. That will give you that number here. And to figure out your principal, well, you just simply get this number, subtract it off your payment number, because we know that payment number is going to be pretty permanent. And that gives you how much is being applied towards the principal. I'm going to break that down again nice and slow for those that didn't follow through. Trust me, I'm not a math guy either. To figure out what your current interest owed for the next monthly payment is, you get your loan balance. You multiply that with the current interest rate. Whatever that number is, you divide it by 12. And that's how you get the number that you're paying for the interest. And you get whatever number it is that you're paying monthly, you subtract with the interest and you get the principal paid. So as you can tell, the interest ends up really high. In this specific example, you actually start off paying 85% of your mortgage payment to just interest. And we see that principal only slightly growing $1 or $2 every single month. And the reason is because when we run the formula again the next month, our loan balance went down slightly. It went down approximately $355. So that interest goes down slightly and that principal goes down slightly. And the way it works over time is you end up paying a lot of interest up front and you end up paying a little bit of principal. And as time progresses, you end up switching it over where it's a lot less interest and then eventually you pay a lot more principal. Yeah. It's probably settling in, huh? Yeah, you pay a lot of interest. Fun fact, in this specific example, even though it's a 30-year mortgage, you end up paying half of the interest that you were going to pay over 30 years in just the first 10, a little bit more than 10 years, like 10 years and a few months, you would have paid half of the entire interest amount. So yeah, if you just pay the minimum payment, they end up making a lot of money off of you and ultimately they win. Right? They not only got their money back, but they made much more money off of interest over time. So can $500 really make or break us? When you make an extra payment a month, you have to make sure that you apply it towards the principal. When you're making your mortgage payment, odds are you're probably going to be doing it online. Well, there's going to be a specific column, like as you make your payment, that says amount applied towards principal. So it's important that you just don't give an additional $500 as a payment. When you give that payment, you want to actually make sure it applies. So now let's break down what happens when you add those extra $500. Look at the remaining balance here, right? Balance is important because remember, we use this balance to calculate the next interest. Okay, you can see here to here the balance only goes down, what is that, $355, right? So we're only seeing it go down in $300 increments. So you're seeing that balance just slowly go down. Well, when we pay that extra $500, those $500 don't get applied towards paying interest. It gets applied towards the balance. And because our balance went down by $800 instead of $300, the next month they're now calculating less interest. It starts kind of building and snowballing, and we're noticing just here, looking at the total years to pay off, every 500 I add starts slowly ticking and growing into something much more beautiful. By typing 500 here, we're going to apply 500 to every single number, and let's see what happens. I want you guys to look at the total interest paid, and I want you to notice the total years to pay off. By adding an extra $500, we've dropped down our mortgage approximately 10 years, and we're now paying about $297,000 of interest. It's much less than the purchase price now, $100,000 less, and no longer after 10 years are we paying only just half. Now I want to do a quick little adjustment here in my calculator. If we did honor and paid an extra $500,000 every month, then we have paid an additional $116,000 out of our pocket. It's a lot. An extra $500 over 19 years is a lot. Sorry, I just ended up getting an idea and I ended up tweaking with the numbers. As you can literally, as the video is going, you can see live how I adjust my tools. So I decided to add a different column just to kind of see the total paid. If you were to just pay your minimum payment for 30 years, at 6.5%, your total paid out of pocket plus interest plus principal everything would be $893. If you were to give an extra $500, that would go to $297, which it seems like it's a big loss, but really you're only paying about that $893 is going to go down to $805. So really you saved yourself about $90,000. So that doesn't seem like a lot, right? Oh, it's only like what, $90,000 or $100,000. But what you're not considering is your house is paid off in 20 years. So in those next 10 years, you don't have to make a freaking mortgage payment. So how would it look like if we can calculate the monthly payment, what it would have been in those 10 years? Well, actually, I just added it right now. What I ended up adding right below here is what happens for the remaining time. So in this case, it's 10 years. If we were just to apply what the principal and interest would have been multiplied by those 10 years. We're not including the insurance and taxes in that number because technically you're still paying insurance and taxes. You're just paying it differently now. You're paying it annually or every 6 months as opposed to as a monthly payment. So $317,000 is what you would have saved in just principal and interest payments for those additional 10 years. And that's just for $500. We can like just play around. Let's say you don't want to do 500, you commit to 100. Well, if we look at here, if we go back to 0, and then we see our total interest paid, total paid, an extra $100 a month brings that down $70,000. It brings down our total paid only about 30-ish thousand. But with that money that we're going to save in those additional 3.2 years that you're not paying a mortgage in just principal and interest payments is about $94,000. So if we were to apply that savings after payoff to your total paid, it definitely adds a difference. And just for funds, what happens if I do $1,000? Well, my total paid is $783. My interest paid is to about $215. I paid it off in 15 years, but in those 15 years between the time it gets paid off and the 30-year time where I was supposed to stop paying, that's about almost $460,000 of just principal and interest payments I'm paying. So getting that mortgage paid off sooner is truly a blessing, and it's something that I hope that we experience in our lifetimes. I'm almost tempted to say, like, maybe don't consider buying a house unless you can do something like this, because really 30 years of minimum payments is exactly what they want you to do. You need to do your best to try to not get yourself in that situation. Now, if you've already bought a house, I wish you the best, and please start making extra payments. And if you haven't, listen, I made this video a few years ago. It's a little bit of a classic. I look a little bit fresher, a little younger there, but I recommend it highly. Some of the advice I give there is going to be relevant forever. It's one of my only videos that has over 1 million views because it just is that good. So I recommend you go watch that one so you know what mistakes to avoid when you're starting the home buying process. I wish you guys all the best. Thank you. See you on the next one.